Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's our outlook on the stock market after a volatile first 6 months of 2025. After a fast bear market from February to April, large cap indices like the Nasdaq 100 and S&P 500 are back at or near their record highs. Meanwhile, small cap indices like the Russell 2000 are still struggling to bounce back. Small cap stocks tend to be more cyclically sensitive and less exposed to one sector like technology, so we consider them a better gauge of the health of the underlying economy. The S&P 500 price returning near a record high means that its valuation is back towards an extreme level. For a single day in April, the forward price-to-earnings ratio of the S&P 500 returned to its 10-year average of about 18 times. Now we are back at 22 times, which means investors have little fear about downside scenarios over the next 6 to 12 months. High valuation does not have to revert to the average on a short-term basis. Stocks can stay priced at this level for 1 year or longer. But what it does mean is the expected returns for stocks over the next 7 to 10 years is lower than average because the current valuation is so high. One thing we noticed during the April sell-off is how investors are using defensive sectors in their portfolios. Basically, they aren't using them unless panic hits. This chart shows the performance of cyclical sectors versus defensive sectors over rolling 2-month periods. The swing to record outperformance of defensive sectors in April, followed by the best cyclical outperformance since 2009 over the most recent 2 months, tells us that investors are avoiding defensive sectors entirely until a panic strikes. Then they rush to defense until things look calm again. We disagree with this approach. Sure, there are many high-quality businesses in cyclical sectors that exhibit good fundamentals most of the time. We like owning companies like this too, but we do not want it to be our entire portfolio. There is still room for about 15% of a stock portfolio to be invested in consumer staples, healthcare, and utilities companies. They aren't exciting investments, and they may only appreciate at about a high single-digit rate over time, but we are very glad to already have them in a portfolio when a bear market hits stocks. Another sign that exuberance has returned to the stock market is the recent outperformance of non-profitable companies and meme stocks. Goldman Sachs tracks the performance of a basket of non-profitable tech stocks and a basket of meme stocks, which are the companies that are popular with speculative investors like GameStop. After falling substantially into the April low, these baskets are now up by 30 to 50% over the past couple months. It's an additional data point that there is a lack of fear by short-term investors looking to make a quick profit. One factor working against these speculative traders is the return of a true Treasury yield that delivers a 2% return after adjusting for inflation. Non-profitable stocks performed great in the 2010s when interest rates were at zero. But now that Treasury yields are delivering a real return after inflation for the first time in 15 years, we've returned to a market like the 2000s, when real cash flow needs to be delivered by a company for its stock to perform well through an economic cycle. That's why we put so much emphasis on free cash flow generation in the businesses that we own. For the second time in the past 25 years, the outperformance of U.S. semiconductor stocks has led to a spike in its collective weight of the overall index. The first time this happened was during the dot-com bubble. Semiconductor stocks went from 3% of the index to 7% in a short time. But within 2 to 3 years, it was back to only being 3% of the overall market. This has happened again in the past 3 years, with semiconductor stocks going from 4% of the index to now being at 10%. Semiconductor companies are great businesses. We have owned them in the past and would love to own them again in the future. But this is one of the most cyclical industries in the world, and it would not surprise us if semis underperform over the next 2 to 3 years. The price of oil has experienced some wild swings in recent weeks during the conflict between Israel and Iran. And despite the most recent price swing being downward, we're still bullish on energy stocks. We expect inflation to increase in the back half of 2025, which is broadly positive for all commodities, including oil and natural gas. It's also worth noting that in the past, when oil experiences a rare day like the one highlighted in this chart, with the oil price rising by more than 3% to start the day before closing the day down more than 3%, historically the price of oil and the performance of energy stocks has moved upward in the year ahead. We still like how much cash flow these businesses are generating and the restraint they are showing on capital spending. One other consideration for investors today is the dwindling gap between the earnings yield of stocks versus the bond yield you can get from treasuries and corporate bonds. This chart shows the widest gap between the earnings yield of stocks as well as the bond yields for short-term treasuries, long-term treasuries, and investment-grade corporate bonds. After the 2008 financial crisis, the relative attractiveness of stocks was historically large. But now the gap between a quality bond yield versus the earnings yield of stocks is the lowest in at least 40 years. It's not an apples-to-apples comparison because stocks can grow their earnings while bond coupons remain fixed, but we think it's important to note because investors need to be confident that the companies they choose to invest in will deliver on their growth initiatives. Otherwise, they may as well own bonds and collect the same current yield. A long-term forecast by MRB Partners illustrates this point well when looking at expected returns by asset class. Over a 10-year horizon, expected returns are more predictable because the starting valuation becomes more critical to the outcome. What's noticeable is the 10-year expected annual return for stocks, bonds, and cash in the U.S. are all around a mid-single-digit level. That forecast seems reasonable to us given the current bond yield of 4 to 5% and the high starting price for stocks. We aren't trying to be downcast about future returns for financial assets, but we do want to be realistic about what to expect and be intentional about the risks we are accepting in our clients' portfolios. We hope this gives you a sense of how we're looking at the stock market after the first half of 2025. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.